everyone, and welcome to your Glassnode video update for week 15, 2023. So Bitcoin has finally punched above the $30,000 level. And what we're going to be looking at today is breaking down whether this was driven by leverage in futures and options markets, or was it driven by the spot market? Now, naturally, both of these markets are always present, they're always active, and they interplay and relate to each other. But generally speaking, there's typically something that's driving these events. And what we're going to do is use a suite of data to really understand exactly what's going on and just try and break down what components of both the leverage derivative market and what's going on in the spot is actually driving this particular rally. So it is certainly nice to see Bitcoin break above 30,000. This puts it up over 80% year to date. So it's been a fairly tremendous year for the orange coin. And what we're going to be looking at today is how, it's posted the strongest return since the November all-time high. And we'll look at both a new dashboard that we rolled out to explore this, but also having a look at some of the dynamics that have caused this. So we're going to look at futures and options open interest and some of the leverage in the system just to kind of set the tone for what's going on in those markets. We're then going to look at things like funding rates and a bit of the option speculative premium just to understand the mechanics of where that leverage is actually going. Because obviously seeing that there's open contracts is one thing, but understanding their character and their nature is another. Then we're going to shift across and look at the on-chain activity side of things, which is really trying to focus in on that demand and adoption side of the equation. And we're going to close out by looking at the accumulation trend score, but we're actually going to start by looking at a new model, which we call the yearly absorption rate. And we're going to look at this for shrimps, whales, all the different sea creatures we tend to look at, just to understand the relative change in supply that we've seen. And there is a report that we recently released called the Shrimp Supply Sync, which you'll find in the description below, that really tries to guide you through this. So as usual, please do give us a rate, share, and a subscribe. It does help this channel get to more people. As always, let me know if you have any questions in the comment section below, and we will get stuck into it. Let's go. Now, just before we kick this off, we did actually just release a report on our Glassnode Insights portal. This was week on chain 15, and we are simulating the Shanghai sell side. So this is obviously a very, very significant event, which is upcoming for the Ethereum network. So just to give you a bit of a background, we actually did quite a big deep dive looking at the actual nature of stake, how much stake is actually likely. We bucketed into different cohorts, looking at how long validators have been around, the size of them, how profitable they are, and whether they're an individual or a staking provider. And really the goal of this analysis was to try and understand the distribution, the cohorts. You'll often hear us talk about this in on-chain analytics. We'll talk about the cohorts of different stakers and trying to find out, was it Binance or Kraken? They deposited earlier in the cycle. Are they the ones more likely to actually release their coins? What about those who are individual stakers, and how has the dominance of Lido and liquid staking providers evolved? So it's a very, very comprehensive report looking at everything from solo stakers to whales. And really the end goal here is to break down who is the most likely and at what volume are we expecting these coins to actually get released. So you will find a link to this particular report in the description below. I do recommend you check it out if you have any interest in this particular topic, because obviously the Shanghai fork is upcoming, and there's been so much speculation about what kind of sell side pressure may occur that we've actually run a series of models. And the nice thing about this is we've compared those models to what we can expect from a typical exchange inflow basis. So once we actually develop our model, we can then actually frame it up and have a look at what does that compare to on a day-to-day, and really gauging this chart here. We're basically looking at the typical daily inflows, and then we're looking at our different cases, the maximum potential that we're expecting, what our typical current status would look like, and what our best estimate is. So a really, really good report. Strongly recommend jumping into that if you have interest in the Shanghai update, because there's a lot of speculation, and this is a really neat way to actually group it all together, look at different cohorts, and truly understand the problem. Okay, so jumping across to our week on chain dashboard, and what we're looking at here is the quarterly, monthly, and weekly price performance for Bitcoin. So obviously it's been a very, very strong year to start off. And you can see here in the orange, this is our quarterly performance. We're up over 80% over the last 3 months. And as we're only just a little bit into April, this is essentially picturing most of our year to date. Now, the last time that we had significant quarterly and even weekly here in the blue price performance like this was really back at the November and October all-time high. This is the last time that we had such strong price performance. Now, the other thing that I would note how back here in October and November, this was quite a fleeting event. We actually started to decay from that point onwards. If you look at the 2019 run, we also had this type of peak. But if you look at 2019 and also our 2021 run, you can see they were quite full. These periods of time when we had strong outperformance were, I mean, as a bull market is, a prolonged period. So you can see here that this has been a fairly consequential 3 months. And really what we're going to be looking at here is, does this continue into the future? Do we actually still have this strong performance? Is this a little bit more bull market type behavior? Or is it a bit more like this fleeting 3 months up and then after this was a bear market that followed? So trying to get a bit of a gauge on where this actually sits in the overall cycle of things. So moving across and starting with our view on the options and futures markets. This is obviously where a lot of the leverage comes in, but you have to remember futures and options are also tools used to hedge risk. So it's not all speculative premium, although a lot does come into these markets. But what we're really looking at here is how much of the market is being moved around and kind of driven by the options and the futures side of the equation. So this particular chart has three traces. In the orange, we have futures open interest. And then in the blue, we have options open interest, both in USD terms. And then in the red here, we have our ratio between the two. So options divided by futures. Now, what you can see is that this chart, this red chart, has really climbed pretty much year to date, or more or less since FTX imploded. We've had an uptick in options dominance. And actually, you can see this week that, or over the last couple of weeks, options in blue has actually surpassed for the first time futures open interest. So there is a lot more derivative activity happening in the options space. So this is going to be something we're going to focus on, but this is the first time that we've seen options have the same size, but actually in this case, more open interest in the futures market. Futures are actually relatively flat, right? Even if we go back here in June, September 2022, we're at levels very, very similar, even though price is substantially higher. So there's actually not that much going on. The futures market is quite quiet. Now these two charts, because if you have a 1 BTC futures or options position, then that's going to move with the price. Because if you have a 1 BTC position at 28,000, it's worth 28,000. At 30,000, it's worth 30,000. So what we've done here is we've priced it in BTC terms, and that's going to remove that impact of coin price, and thus give us a much better gauge on whether open interest is climbing as it was in the late stage of 2022, or in futures markets, it's actually been in a multi-month, since FTX, a multi-month decline. Now, this initial decline is obviously because FTX, which was a major trading venue, is no longer with us. But this has been a continual downtrend in overall futures leverage. And here you can see options have actually started to become the preferred place for this leverage and hedging to start to come into the market. Now, obviously, with Bitcoin coming off the lows that we had back here after the FTX event, the question is how much of this open interest is actually being driven by speculative call option buying, or is it actually hedging risk using put options? So to answer this question, we're going to quickly jump across and have a look at our open interest by strike price. Now I've set this out to the 26th of May, so a couple of months out. And what you can see is that in the green here, these are call options. And you can see that there is a whole lot more call option activity. In terms of puts, there's actually not that much going on relative to calls. So people are buying call options. And you can see that we see clusters around the 30,000s. You can see them up to 35, 36, 40,000. So these are quite speculative. These are people who are essentially speculating to the future that we will have a higher price. I'm just going to bring it back to the end of this month, at end of April. Note that we have a lot more put options relative to calls. So in the short term, the market is actually quite hedged to the downside. We could see 20,000, 25,000, and a few up here in the 40,000s for call options. But now let's take it out to year's end. And you can see we have call options out 40,000, 50,000, 65,000. So really the big takeaway from this is this options open interest, a large proportion of it is call option speculation, out of the money call options. Now, the other thing that's quite relatively healthy about that is when you're a buyer of options, you know your risk. You're essentially buying an insurance contract. So therefore you can only lose as much as the purchase price. So options tend to have a bit more of a defined risk reward profile. So therefore, what we're actually seeing is most of this is speculative leverage, but it's not necessarily leverage that gets liquidated, so to speak. The way that you see deleveragings that we saw through 2022, this is a little bit healthier in terms of the overall leverage. It's essentially people putting on a defined amount of risk and taking a bet. There's obviously somebody, the market makers, who are selling the other side of that call option. But generally speaking, this is a healthier form of leverage. It's certainly a better overall market structure compared to what we saw through 2022, which was and 21, which was basically people betting long on on futures markets, which had very small stop losses with lots of liquidations that followed. So now we look at the futures market. How much directionality is in there? We've got open interest. Obviously, it's non-zero. We're kind of back down to our baseline we saw through 2021. So how much speculative premium is in the futures markets? Well, this is looking at our funding rate and our 3-month rolling basis. The way to think about this, it is the interest rate that investors or traders are paying if it's positive to be long, if it's negative to be short. So it's basically like an interest rate you pay for the privilege of taking on that leverage. Now you can see that we are currently hovering around 2.3% or 2%, which in the grand scheme of things, when you compare it back here to the 2021 mania and even the all-time high, these were getting up to rates on the perpetual market, sometimes 100% per year. So you were getting paid 100% per year as a market maker to go short and take the other side of the trade. Here, with 2%, this really indicates there's certainly a long bias, but it's not exactly the most extreme leverage we've ever seen. People aren't chomping at the bit to get a long position in the market. So given that interest rates in the bond market, even if you look at US Treasuries, they're up over 5%. So people can actually get a superior yield by putting their money into a money market fund. So really, it's certainly positive, but it's not extremely positive. So to me, that tells me there's not a huge amount of long bias. There's always going to be some people who are long and get liquidated, but overall, this is not an extreme bias. It's just a bit of a bias to the positive side, which during an uptrending market is to be expected. If we then move across and look at our liquidations, you can see these large red candles. This was on the rally that started back here in January. There was another one as we rallied up to 28,000, and there was about $64 million, worth of short liquidations on the way up. But this is quite zoomed in. We're basically looking at the last 1 year. Let's look at again in the full context over a couple of years. And what we can see is that our current liquidations are pretty minuscule by comparison to what they were. These were getting up over hundreds of millions of dollars in liquidations, whereas over here we're talking about 64 million during a significant up move. So in many ways, it's not really indicating. There's certainly some parts, and futures will have a role, and so will options. But this rally to 30K doesn't necessarily feel like some of these massive levered long squeezes or short squeezes. There's a little bit in there, but it doesn't feel like the primary driving factor. So now let's transition across and look at it from the spot domain. And this is really where on-chain analytics shine. And there's a few things we're looking for here. We're going to start with on-chain activity. Generally speaking, when you see greater adoption, it's a positive thing. You're seeing more people coming into the network, more people are engaged with Bitcoin, more coins, more transactions, more volume. It's generally a good sign, a sign of adoption. Now, you'll know if you've been watching this channel that we love to use our momentum indicators. They are fantastic for looking at on-chain activity. And that's where we use the monthly in red and compare it to the yearly in blue. So on the left-hand side, we have new addresses. So this is kind of new addresses coming into the network that haven't been seen before. And then we also have transfer volume. And here we're using our entity adjusted model. So this is really using the cleanest data that we have on volume. And the reason why I'm looking at both of these together, if it's an active address or a new address, but it's got 10 cents worth of Bitcoin, who cares? But if it's there's new addresses which are ticking higher, and you can see we do have positive momentum here, and we also have an uptick in transfer volume. That's two different metrics. That's showing you that we not only have activity from a user-based perspective, but we also have activity from a transfer volume perspective. So both of those pieces of the puzzle are there. We can also look at things like fee revenues, fee Z scores, there's various other metrics, but you can see here that we are in a positive territory driven by new addresses. Part of this will be ordinals, by the way. And the other thing we have here is transfer volume is in the process. It's not quite there yet, but it is in the process of breaking towards positive momentum. So both of these are more positive than negative. Now, the other thing that we tend to see is that when there's more activity and there's a bit more speculation and people start trading it around, exchange dominance tends to climb. This is natural. Exchanges tend to be the primary venue where people are buying and selling coins. Many people will buy their coins, withdraw, and then send them back to sell, and some will actually trade. Given the FTX event, I actually expect there'll be more people who are kind of holding their trading positions in their own wallets just in case anything happens on exchanges. This will start to happen. Now, what we're looking at here is the transaction counts. So you can see we have a very strong push higher on transaction counts. This is also in very positive momentum. It's actually not quite at all-time high, but it's getting there. Again, this is going to be influenced by ordinals as part of that mix. But you can see we have a very, very slight uptick in our deposit and withdrawal dominance as well. Dominance is down, but the amount of deposit and withdrawals are starting to tick higher. So it's kind of very early days. It's not a negative sign, but it is showing that we have adoption growing on the network itself. And then the last one we're going to look at here is the exchange volume. So this is the amount of volume flowing in and out of exchanges. This one here has recently broken into positive territory. It is starting to curl over, but you can see here that we tend to get these kind of oscillations. 2019 was a good example, but remember, 2019 went into another year-long reaccumulation period. So these things are never a straight line. But again, when we look across the whole spread of things, we have uptrends and positive momentum across many of these things, which is more positive than negative. So the next thing we're going to move into is looking at our realized profit and loss. And we're going to look at this from two crowd favorite metrics. I use these all the time. One is our aSOPR metric. Here we're using the adjusted variant and our realized profit loss ratio. So for both of these, I mean, at a very high level, in a bull market, people realize profits. In a bear market, it's much, much harder to do that. So generally speaking, an indicator that we're moving back into a bull market is there being more profitable activity. Coins that are transferred on the network are typically in profit rather than in loss. And given that we've had a strong rally off the bottom and we're up 80%, this is generally going to give us a bit of an indication that we're starting to get a bit of a recovery. Now, the other thing to note with aSOPR, note that during bull markets, we tend to get these retests of one, and they tend to be points of support. During bear markets, you can see it back here in 2018, a level of one is typically resistance. What's going on here is that in a bear market, a value of one means people are spending coins at their break even. So from a psychological standpoint, just give me my money back. I'm down so bad, I just want price to rally. I want my money back. That's the logic, and that's why we actually create sell side when aSOPR comes back up to one, because this is people who are taking their money out of the market and saying, I don't want to deal with this bear market anymore. We can see we spent quite a bit of time retesting this level from below until FTX had our final capitulation event. Now, as we start to break up and above, right, in this, look at 2019, this rally, there was lots of people who were still looking at this and saying, oh, the PTSD from the bear market is so strong, I'm going to sell at a loss, right? People see the price rally and we get a tiny little pullback and people capitulate out. They're panicking, concerned that we're actually going to head lower. This is just another lower high. I'm tired of seeing these lower highs. Note that in our current market, we actually dipped right down below one, and we talked about this a couple of weeks back. This was actually short-term holders who bought this local top, and long-term holders from the previous cycle panicking that this sell-off down to 19.8 was heading much, much lower. So they actually sold at a loss, and then we bounced back into profit. And then we had another dip and more people sold at a loss. Again, these are people up here who bought the top. This feels like there's a lot of people who are still unsure whether the market is recovering or not. Despite the fact that Bitcoin's at 30,000, there are still people who are taking losses. So what we can see is that this chopping around in many ways kind of indicates that the market doesn't quite believe where we currently are. It's showing that some people are still willing to sell at a loss. Some people are taking profits, and it's a bit of a mix. We're not quite at full bull territory. Look back here in 2021. Full bull territory shows that just everyone is taking profits. Everybody's in profit, and it's very, very hard to take a loss. Here, we're still chopping around that in-between nebulous phase in between. Now we can see this on the realized profit loss ratio. This one here is going to be a bit slower. It's not going to be as responsive as aSOPR, but it's much better at looking at the big macro shift. So you can see it in 2019 broke into positive territory, essentially on that candle back here on, I think it was April Fool's Day, 2019. And that's when we started to move up into this positive territory. We have had our first break above. We've seen people actually capitulate on that low down here at 19,800, and then a strong push back into profit. So the big takeaway here, the market is able to realize profits and the market keeps pushing higher. So there is sufficient demand inflow to absorb that sell side pressure. That's really the takeaway, and it does start to look a little bit like a character shift. We're seeing profit re-entering the market, and that's not going to happen during a bear market because it's pretty much down only. So it's starting to give a bit more credibility to that fact there could be a real transition that's at play. Now, obviously, these things never go in straight lines, so we do have to just keep an eye on these things. This does mean that people are taking profits. That's eventually going to create an oversupply because naturally, the most profits in a bull market are realized near the top. So eventually, this thing reaches a point of resistance. But so far, it's still a bit of a disbelief type behavior that's going on from many investors. Now, the last thing that I want to touch on, and we released a report, I mentioned this at the start, called the Shrimp Supply Sync. Strongly recommend checking that out. There's lots of critics who love to point at the Bitcoin supply and say, oh, look, all the coins are held in, 1% of all wallets. Well, what we do is we break this down into our different cohorts: shrimp, whales, fish, all these different groups, and actually debunk a lot of those myths. Now, these were metrics that help us understand who is growing their share of the network and who is losing it. What we do here is we call them the yearly absorption rate. So the concept, look at all the coins that were mined by miners over the last year. That's kind of a standard baseline. For argument's sake, 900 coins times 365 days, that's how much coin supply we're talking about. Now, if the shrimp accumulated that volume, then this reading will be at 100%. If they sold that volume, that's essentially miners selling those coins plus an additional distribution by those shrimp cohort. So that's kind of 200% of the mine supply needs to find a new home. Now, what you can see here is we have shrimp, we have crabs, and we have fish. This is everybody holding less than 100 BTC. Now, note that all of these are actually at very, very high levels, pretty much all-time highs. Shrimp have actually accumulated 117% of all coins mined. So think about that for a second. Of every coin that was mined over the last 12 months, shrimp consumed all of them plus another 17%. Crabs consumed about 100%. So there's another total mine supply. And the fish is around 70%. So that's a lot of coin supply, but there's only so many being mined. Where did the rest of them come from? And the answer is that from the purple curve here, this is whales. Whales actually distributed about 70 odd percent equivalent of the mine supply. And the remainder came out of exchanges. This massive downtrend here we see in 2022 is actually exchange volumes getting flushed out post FTX during the deleveraging event. So in many ways, coins are actually transitioning from the whale cohorts and the exchanges across to smaller investors. Now, the interesting thing about this, personally for me, when I look at this is actually a very healthy mechanic, because what you're seeing is that Bitcoin's always been a grassroots event. It's kind of been one of these assets that's always had a retail focus. And we're actually seeing that shrimp and these smaller cohorts, and by the way, if you look at cohorts up to sharks as well, so we're talking about institutional size up to 1,000 BTC, they are also adding to their balance. So we're kind of across the board, we're seeing a distribution from the largest holders, the whales, and the exchanges out towards retail all the way up to institutions. So in many ways, that's actually a distributive effect. And this is something that's been going on for many, many years that we cover in that report. So it's worth checking that one out. And to close, stitching all those ideas together, we have our accumulation trend score. So this one here will show purple when on-chain wallets is actually increasing. It excludes exchanges. So it's going to pick, it's kind of going to summarize those charts we just looked at. And you can see that we have seen a period of strong accumulation up here at 28,000. That means that spot, there has been a demand for spot. Coins are still coming out of exchanges. They're being distributed by whales and going back towards those smaller holders. We are seeing accumulation both after FTX, after Three Arrows blew up, after Luna collapsed, and in our current $28,000 range. Now, of course, people also accumulate at market tops. right? These things are never going to be binary, but it's about putting this story together. If we go back to the original question of this episode, it's about what was really driving this rally. Is it spot or is it leverage? And considering leverage appears to be flushing out of the system and spot actually appears to be quite strong in the on-chain space, in many ways, it feels a lot like spot is actually still in the driver's seat, which following FTX and following all that deleveraging, this really doesn't surprise me too much. So thanks everyone for tuning in. Hopefully you enjoyed that session. Do make sure to check out, we've recently released a brand new dashboard which looks at price performance. This is so we can track out Bitcoin's performance over different cycles since the halving, looking at it between different market cycles and how did daily, weekly, and monthly performance go. You'll find a link in the description below. And I do hope you enjoyed that episode. If you have any questions, you can reach me in the comments, and I will see you in the next one. Cheers.